Hi, everybody. Welcome to Ask the Planman. I'm your host, Bruce Weinstein, and I believe each and every one of us deserve a plan in life, whether it's a financial plan, retirement plan, college plan, educational plan, tax plan, health plan, exit plan, business plan. Planning makes up every part of our lives, and we should all have a plan in life. Today, I'm excited to be joined by Bill Pauley, who is the National Marketing Director with Healthcare Solutions Team and also the owner of the Pauley Agency. Bill's been with Healthcare Solutions Teams for the better part of 10 years. He's based in St. Louis, Missouri, but he's originally from Nashville. We all love Nashville, Tennessee, so you may pick up a little bit of Nashvillism in his twang. Bill spent 26 years as a music director in the church area with a variety of functions centered around organizing services, choir programs, special events. But Bill always had a passion for something more service centered and helping other people. And he found that our industry, the insurance industry, could help him advocate for people, help them understand more about the world of insurance, but equally as important, finding a balance in life and taking charge of his own destiny. Bill's married to Lisa for 34 years. He's got a daughter, Morgan, who's married to Martin. And the apple of his eye is these days is his 2-year-old grandson, Carter, who he's currently spending with right now as we're speaking. He also has a son, Logan. And then he's an equal opportunity pet owner. He's got a cat, Cringer, I think it says, and a dog, Ellie. So we're just dog people. We're not necessarily cat people, but that's because I'm allergic. Robin's a cat person. So, Bill, welcome to Ask the Planman. Glad that you could join us. What I want to talk about today is what is ASA? Oh, God, ASA. ACA. What is the ACA, the Affordable Care Act? And I want to break this down for our listener today so they can better understand what ACA is all about. So tell us what ACA is.
Well, thank you, Bruce. Thank you for having me here. I appreciate the opportunity to spend some time with you and talk through some of these things. Before coming into this industry, like you said, I had no clue what health insurance was. And a lot of people out there have had plans for years upon years and just do not understand how plans work and how they are beneficial for them if something goes wrong. The foundation of ACA was built around giving people opportunity to have plans. Before the Affordable Care Act came into being, there was major medical insurance out there, but people who had pre-existing conditions such as cancer or heart attacks or diabetes, these major ongoing types of things, were not able to get major medical. They were, had to have other choices, some kind of guaranteed issue plan. There were some states that offered guaranteed issue type of plans, but they were very expensive because of all the conditions.
So let me just rewind just for a second, because some people may not know the terminology Affordable Care Act. They may know it as a more common used name these days, and that's Obamacare. Because President
whatever
Obama
you call it. Right. Yeah, whatever you call it. Obamacare, Affordable Care Act, the Marketplace, the ACA, major medical. It's all major medical, right?
This is all synonymous terminologies that people will have intertwined, and then certain people have different views about Obamacare. And I think what I want to get into some of this with you is the confusion behind it. Obviously, we want to break down what it is and who qualifies and the benefits in there as well. But certainly just in the fact that there's 4 names to it adds to the confusion of it. And so our roles as advisors.
If you go back into the history of it, there's more names than that, because it actually started with Mitt Romney out of Massachusetts, who built their own plan for their state. And that's what the ACA was built off of. So it crossed the aisles, Republican, Democrat, it didn't matter. The plan came to be during Obama's tenure. So that's why it got that Obamacare type of name to it.
While you're on that for a second, so again, I want to kind of give some facts in here so people understand, because I just had this conversation before we started recording, is when the Obamacare platform came out, there was a mandate that if you didn't enroll in some form of qualified health insurance, there was a penalty. And so there was, I believe, a substantial $600 a month type of penalty if you did not enroll in some kind of qualified health insurance. That eventually, when Trump came in, he didn't abolish Obamacare. It's still in place, but he did get rid of the penalty. And again, there's a lot of confusing things. And I want to kind of disnomer some of this confusion as we go through this as a learning for everybody. Is there is no penalty today. You're not forced to get on a plan, but certainly we're encouraging people to have major medical coverage.
Yeah, let's clean that up a little bit. There is still the penalty there, but it's not mandated. So they don't enforce the penalty anymore. So the Trump administration did take away the mandate, but the penalty is still law. The penalty for it is still law on the book as far as having coverage and stuff, but they're not enforcing it currently. And
just real quick, to be clear, Trump put it to bed somewhat, but Biden hasn't reinvoked it either. So it's still not an active. So just so, correct, again, people understand, it may not be gone. It's not in effect. It's not being activated, which means it could come back if somebody eventually decides to turn it back on.
Correct. It could. Yeah. The government likes to mess up everything. So who knows what will happen. What we did find when that was put in place, there was a lot of confusion, which is why, I came into this right at the beginning of all of it, which is what really fed to my passion, like you talked about, of helping people and helping them understand what it was and what all it meant. The penalty itself did not really hold much weight. There are several loopholes around even getting penalized if you didn't make a certain amount, and the subsidy that was given, the only way that they were able to recoup that penalty or that subsidy back was through the taxes. And if you weren't getting any kind of refund on your tax form, then they didn't send you a bill. So there were several different loopholes and stuff, ways around that people, it really wasn't that strong of a penalty either way. So that mandate didn't hold much water at all.
So in the years we've been doing it, we've seen some evolution and some changes to it. So I want to kind of give a 2023 version of things, because there's been some changes in there as well. But back to the confusion side, what I always like to make sure the audience understands is they can go do it themselves. You mentioned healthcare, .gov, as it's referred to as the healthcare.gov, the ACA, Obamacare. So the biggest problem we find is people try and do it themselves. We are keenly delivering messages of don't go it alone. It doesn't cost you extra to work with Bill or work with Robin or I. And it gets very confusing trying to go through the applications online or even with one of their reps. And so we're empowered by them to enroll people with their permissions, and we're compensated by healthcare.gov or the carriers, whomever. So we always encourage people, don't go it alone. And 99 times out of 100, we're fixing their mistakes. Correct. And they just don't because they don't know how to answer things. And so they struggle with that. So
the reason is if they do call into healthcare.gov or they try to do the application themselves, the navigators with healthcare.gov are not licensed insurance agents. All the navigators do is help them go through the application process. They cannot advise them in one way or another. So whether they use me or some other broker or agent that's out there, I think it's super important to have someone who understands all the implications of what these plans are and how they are best to be used. Because if you're not putting the information in the right way, you could be penalized later on your taxes because you got subsidy you weren't supposed to get. Or you may get a plan that none of your doctors are in. You have to really work the networks and make sure that the coverage that you're looking at makes the most sense for where you're at.
So again, I'll break it down a little bit further. And the process is, as you're building the application, from our vantage point to the listener, You can do a quick quote where you're plugging in zip codes and everybody's ages, and you kind of get a sense of the subsidies. But it doesn't stop there. You have to start drilling down. So what Bill's referring to is, now I start getting a list of your doctors. Who's your primary, who's your OBGYN, your urologist, who your kids see, whatever it is. And now you start plugging those doctors in, and guess what? Different plans are moving up the chain or down the chain. And then you could start to filter in, well, which plans have the most access to my doctors, or the most doctors are in that plan. And so it becomes a process of elimination. Bill and I don't care whether you buy carrier A, B, C, or D for an enrollment. It's which plan provides you access to the most amount of your current doctors, because most people want to keep their doctors. And then when the pricing and all of that comes into play, then they have to kind of decide, well, this plan has 3 of your doctors, this plan has 4, this plan has 2. Well, which of the doctors do you want to give up if you want the better plan, right? Or the more affordable plan, depending on the pricing. So again, that's the conversation you're not going to get from the agent, the rep on the phone with the marketplace. They're just going to take you through the questions, get your income, you get your address and your participants, but they're not going to get into the weeds with you on what Bill and I are going to do. True?
True. Yeah, they cannot advise you anyway towards any plan at all. It's just application process for them. So
right. I guess let's put it this way. In a so what is, it's a difference between an order taker and an advisor.
Correct.
They're just an order taker. So if you don't know what you're doing to give them the proper instructions, you're not going to necessarily get the best plan for yourself. Whereas Bill and I are more advisors. We're going to ask you the questions, and then we're going to move you or navigate you through the platform to get you the best options. The next piece that comes into play, which is so paramount these days, is the income declaration. And again, there's a lot of confusion on what people are doing. And you were just talking before about the necessity of the tax return and clawbacks and stuff like that. So let's start to break some of that down. Let's give them some of those terminologies. And then again, where these pitfalls might lie on the do-it-yourself side versus what you and I try and do.
Right. So these plans through the Affordable Care Act are all guaranteed issue, right? So there's no health questions on these plans at all. It doesn't matter what you've had in the past. There's no health questions. There are IRS questions because it's all run through the IRS, and it all has to do with what subsidy that you get. So there's 3 factors that go into making up how your plan looks for you when you put these 3 factors in. Those 3 factors are what zip code you live in, because rates do change based on zip codes and risk factors of where people live. Who all is on the tax form together in that household, and then what the household income is for those people on that tax form together. So those 3 factors will determine what the plan will look like, if or how much subsidy is given to them. And the subsidy is the part that will bring down the premium, the payment per month. Okay. And
so let me just expand upon that for a second before you keep going. Sorry. So the subsidy, basically when Bill and I are putting a quote together, I use it is there's the retail price and then there's the subsidy price. And so the retail price is, well, this plan for your family of 4 is $1,500. However, based upon what Bill just said, your zip code, the census of the household, how many participants, 2, 3, 4, 5, and the income, well, the government now has these charts where you will get a subsidy. Well, what is the subsidy? Subsidy is a tax credit. It comes off of the bill. So when that $1,500 retail price now of a sudden comes down to $200, well, you just got a $1,300 subsidy. Now, to be clear, the insurance company, the carrier that you're going with, they're getting $1,500. No, make no mistake about it. What's going to happen is on your taxes, you're going to get a form that's going to show your subsidies. And then that's why you're mandated. You have to file your tax returns to stay on and qualify for these programs. So again, there's more confusion we'll get into in a minute on the whole tax filing. But if the numbers match, you get to keep that subsidy. if you suddenly had a windfall late in the year and you generated more income somehow, and again, I want to break down some of that. I won't jump the gun. Well, then we get those complaining phone calls. Hey, I had to give back $3,000. Well, did your income change? Yeah, we sold a piece of property. We got a capital gain. Well, your income changed. So again, this is where people get confused. So what you and I obviously do best is help educate people and prepare them of look, the subsidy is only as good as the numbers you're telling me, right? If you tell me you're making 30 grand and you made 40, well, you told me you were making 30. So your subsidy is based on 30. Now at 40, you had to give back some of your subsidy.
And it'd be reconciled through your taxes the next year.
Right. So when you file the previous year, because everything's always kind of delayed, and then all of a sudden they're like, well, I was supposed to get, we love these phone calls. I was supposed to get a refund. And all of a sudden they clawed back some of my subsidy. I'm like, well, what was your income? And I pull up their records and I'm like, well, you told me you were making this. It's like, right. It's not our doing, it's their doing. Right. So, go ahead. So 3 factors, zip code, the census, the household, and the income are going to help determine that. And then I think the importance we could talk about the zip code is we've had clients move even within the same state. And all of a sudden that same carrier is not available. The prices have changed, the subsidy changed. So again, it is real. It happens when people move and they go, well, what just happened? You got to pick a new plan. Your plan, it doesn't work on the other side of the state.
That's true. They are not portable at all. They are just community type based plans in your area. And that's kind of the downfall that, you can talk about. Some of the downfalls on ACA plans is that thing right there. The network that you're in is just your general area. If you go outside that network, you are probably not going to have any coverage at all, unless there is something catastrophic that does happen. Then they have to. But it has to be a life-altering, catastrophic type of event for that coverage to kick in. So it is more community-based area kind of coverage there.
Well, again, I don't know how deep we'll get into the nuances, but there's in-network, there's out-of-network. There's a lot of terminology people just don't understand. Deductibles, co-insurance, maximum out-of-pockets, and this whole in-network, out-of-network. So I don't think we're going to go super, super deep into all of it. Maybe we'll see where we go. But what Bill's saying is, if Bill's lives in St. Louis and his plan is in Missouri in St. Louis, and now he's in Orlando visiting his daughter and grandson, and God forbid something happened to Bill, he's out of network, right? He's not in St. Louis. Now, he's got a cold and he needs to see his primary care doctor. That's different. But if he had an emergency, God forbid, knock wood, well, he can go to Orlando Regional Hospital. They're not going to kick him out. They're not going to not take care of him. It'll be handled and treated differently, but he's going to get coverage. He'll be taken care of. He's not naked or vulnerable. But if he's got a head cold or a sinus infection, he can go to urgent care or something and pay the $50 and be done with it. He's not going to go to the ER for that. But if he's looking for his knee replacement surgery, he's got to go back home. He's not going to get that done, right? Volunteer exactly. Versus emergency. So, exactly. What I think I want to touch on more before we kind of pivot into the different components of this is the income and the subsidies and some of the changes there. Because, the way we label the marketplace, it's for people with pre-existing conditions and people with, let's call it, income challenges, where their income falls in certain ranges and the government is providing some very lucrative subsidies, and it's based upon certain metrics of income. And so those metrics have changed. They've gone higher, where more and more people are now getting subsidies where they thought they wouldn't have in the previous couple of years. So the band has changed. And so we implore people, look, you need to disclose and revisit and take a look, because, a family of 4 making 100 grand, maybe in the past weren't getting subsidies, and now they are. So
correct. Yeah, that band has expanded with this administration that's in there right now. Call it good, call it bad. It just adds more confusion for people, right? As far as what they get, how they get, where they get all this kind of stuff. The overall purpose of the Affordable Care Act was for those reasons that you said, to give people coverage that couldn't get coverage and try to make it affordable. Well, they do that by the government printing money, coming up with money for subsidies, right?
Right.
Because the insurance companies are raising the rates to cover the sick people. The balance of it was to, try to get as many healthy people on the plans as possible to help balance the sick people. Well, healthy people did not necessarily want to pay the higher rates for not so good networks and such. So they started looking for alternative type of plans. And the balance kind of wasn't there as far as having healthy and non-healthy on there.
Let me just jump on 1 second here to hit this point. So what Bill's referred to in our world is called adverse risk. Okay. When people go to get their life insurance, people go to get the health insurance, auto, home. What I want to educate my listener is this. Insurance companies are nothing more than a pool of money banded together. Bill and I, as neighbors, put our money in the pot. And if something happens to Bill, that money's to help him. Something happens to me, it's going to help me. And then you just expand that by tens of thousands and tens of millions of people. Insurance is nothing more than collaborated money. Adverse risk is an insurance company's like, are they a good risk or a bad risk? If Bill's got 17 speeding tickets, 14 accidents, how do you think his auto insurance company is going to treat him? Do you think they want him? Do you think they're going to raise his rates to offset the risk of him crashing into 16 cars? Yeah. So when people are like, oh, my rates are going up and I'm getting, hosed, well, you got to look within, because if you're a bad driver, reckless driver, speeding driver, they don't want you. It's the same with your homeowners. If you're putting in claims for every leak and little ticky-tack thing, and now you wonder why your rates went up and you try and get a new carrier, they don't want you. You're an adverse risk. So a lot of listeners can correlate to that because they've been dealing with that on that side, their auto and the home. So the same thing is here. If I'm a smoker and a diabetic, what kind of life insurance premiums am I going to pay versus the guy who's in perfect health condition, body weight, mass, and the whole bit? Well, I'm going to get a preferred non-smoker rate over here versus a standard, substandard smoker rate. It could be 5 or 8 times the price for their life insurance. Why? Adverse risk. The likelihood of that diabetic smoker that's 400 pounds is going to die a lot faster statistically than the healthy person. And so the same conditions are here, which is again problematic. So I'm going to tie it back to the health. What Bill's talking about is if everybody coming into the ACA Obamacare platform has pre-existing conditions, cancer, heart attack, stroke, diabetes, MS, lupus, well, there's a built-in expense for their care that they're bringing in the door. If Bill's healthy and I'm healthy with no history, knock wood, at the ages that we're surpassing with never having issues, we've been a great risk to them. They're going to offer us better prices in a fair marketplace. But on Obamacare and the ACA, that healthy person is going to be paying higher prices to offset the adverse risk pool that's in there. To you, Bill, am I making sense with what I'm saying there?
Yeah, you're making 100%. So everybody's put in the same pool, whether they're healthy or not, and pays the same rates because they want the healthy people to balance off and take some of the cost for people who may not have taken as well a care of themselves to balance that out. So
now, just so my listener knows, Bill and I are going to do a 2-part. We're going to break this episode down. We're going to talk about what else is available to the healthier person that doesn't have the pre-existing conditions and maybe don't qualify for subsidies. So as we finish this up, stay tuned for our next episode, and we're going to talk about other options around the Affordable Care Act that some people might have. So I just want to tune them in because we're going to make this a 2-parter. So we touched on the factors of the subsidies, the incomes. We talked about pre-existing conditions and the process there. what else are we either missing, or what else do we want to share in the process? You're doing this a long time. What else can we share with people as far as the ACA and the pitfalls? And I think there's one more piece I want to talk about, but go ahead.
Yeah, I would just say, it is necessary, right? It's something that you hope you never have to use, but you're glad you have if something major does happen. That's insurance. And it's good on one hand that the resources are there to help people that do not have insurance otherwise, whether it be a lower income or what. The pitfall, I think, is that it has probably hurt the middle class more than anyone. There's not a balance for middle class. They're kind of in the donut hole of it all.
Yeah.
Those in the lower class get these outrageously great plans with very low deductibles and low out-of-pocket cost. Those who are above the donut and, money's not much of an issue, they can afford any kind of other alternative type of plan or just pay the premium and go with it. Those here in the middle class, don't get as much subsidies, so their monthly premiums are high, and then they're expected to pay, deductibles and out-of-pocket maxes of, $18,000-$19,000 a year for a family.
Yeah,
and it just is hard to really make sense of how it's working for the middle class. It's really not. That's the sector that's been hit the hardest, I think.
Sure. And they come to part two, we're going to talk about what the middle class might be able to find as another option. So we're going to tease them for the next episode. So here's a couple pieces still want to touch on for this episode. So you just brought it up, so let's go with that. There's some terminology that clearly the layperson gets confused on consistently. Deductible, coinsurance, copay, max out of pocket. And you just mentioned a couple of those there. So let's break that down in kind of education 101 on insurance, and let's be clear, these terminologies, folks, are not exclusive to ACA. No. If you have a group plan, if you have a private plan, if you have marketplace plan, all these terminologies you need to know. So if you're a younger person just coming into the workforce and you're offered a group plan, this is the stuff you're going to need to understand and know. So let's give them some of those. So first and foremost would be deductible. So let's describe that for them.
Okay. Your deductible and max out of pocket, right, is an agreement between the consumer and the insurance company, where the consumer is telling the insurance company, I will be responsible for this much exposure. So risk factor, whatever that is telling the insurance company, if something happens, I'll pay up to this limit. And then the insurance company agrees that over that limit, that max out of pocket, they are responsible for everything above it. Okay. So that's your main deductible or max out of pocket. Coinsurance, I hate using that word because it's an insurance type of word. Most people are on plans that have like a deductible, let's say $5,000, and then it goes to like an 80-20 split. That 80-20 split is called coinsurance. So that's another level of agreement between the consumer and the carrier, saying that after I meet my deductible of $5,000, we'll go to an 80-20 split where the insurance will pay 80%. I'll pay 20% up to the new
max out of pocket,
right? Whatever,
which is around 9.
Yes.
Which could be up to 9,000.
Which could be up to 9,000, right?
So I use it as, I kind of say it's as tiers, right? Yes. And we're gonna talk about MEC and copays in a second, but the deductible comes in first. Now that's not usually your routine care, so we're going to talk about the MECs and the routine care. But I like to use the appendicitis scenario, right? Because it's usually not real bad type, versus cancer, heart attack, or stroke. But so if I got appendicitis and I've got a $4,000 deductible, and the appendicitis is $20,000 all in. That's an unexpected bill. That's not routine care. That's not my annual physical. So that's where the deductible is going to come into play. And so your bill's going to be presented with a $20,000 bill. And now Bill has a $4,000 deductible. So right off the top, 4,000 bills, that leaves 16,000. Well, Bill just said he had an 80-20 plan. So of the 16,000 remaining, the patient, Bill's responsibility is 20%, which is another 3,200. So Bill just spent 7,200 out of pocket for him as the patient, but the insurance covered the rest, which is, the 13,000. Okay. Now, Bill has a 9,000 max out of pocket. He hasn't hit his max out of pocket yet. But what we're also finding, and I think you'll agree, is a lot of the Obamacare status plans are not 80-20. They're 60-40, they're 50-50. The higher level plans might be 80-20, but we're finding more 60-40, 50-50. So in that case, everything above the deductible is a 50-50 split, which means they're going to hit their max out of pocket quicker and have a little bit more exposure. Now, again, not to go too deep in the weeds, but people who are getting heavier subsidies, Bill mentioned, might have a lower deductible, a lower max out of pocket, reduced copays, and that's called a CSR, cost sharing reduction. So again, I don't necessarily want to go down that rabbit hole, but if your premiums are being heavily subsidized, then big deductibles and max out of pockets are usually coming off of the table also, where they don't have that exposure. Where you said earlier that middle market, middle class that's not quite getting the fat subsidy, they're not getting the cost sharing reduction. They're going to have a $5,000 to $7,000 deductible, and they're going to have a $9,000 max out of pocket. They're going to hit the top of the bar. So they're the ones that are going to pay. I remember years ago, we had a plan through somebody Robin had worked with. He had some fancy gold plan. It was $800 a month for me to be on it. He paid for her. And then we had a $10,000 deductible. So we're out 20 grand every year for basically nothing. I had to have something pretty dire. Now I got, let's talk about MEC. Let's talk about minimum essential coverage, because that'll tie in here. So what I got for that was my annual exam, my annual blood work, right? Robin would go for, I call it lady visits. So ladies would get their mammograms and the like. Okay. So let's talk quickly about minimal essential coverage, because that's really what to me, the stamp is on all of this, of what this platform versus others is going to provide. And again, the confusion of, because people are like, oh, I want to make sure I get my annual exam, my mammograms, my chiropractor, my therapist. And so a lot of this is provided through the MEC. So let's break down what the MEC is for everybody. And
the minimal essential coverage, that's what MEC is, minimal essential coverage. So as part of the mandate for plans to be considered major medical these days, the government put together a list of like 10 essential benefits that have to be on a plan in order for it to qualify as a major medical plan or ACA or Obamacare or whatever you call it. They're all the same. Some of those things are your yearly physical, mammogram, pap smear, all that kind of stuff. Your yearly physical includes colonoscopy and all that kind of stuff. Other things were maternity, mental health. So there's several different things like that are considered a MEC plan or minimal essential coverage that has to be on these plans to qualify.
What you described, the wellness or preventative care is another way. The annual exam is a wellness or preventative care. So why is this important, and why? And also, let's tie in, like, even copays may not exist in those services. So where you might have a $10, $20, $50 copay to see your OBGYN, your urologist, or your primary, when you're going for your wellness visit, even that doesn't apply. It's a waived feature. So there's no cost for wellness. So why is that? What's the so what? Well, the so what is, if you don't go to the doctor for 3, 5, 10 years, what's the likelihood of you having a major issue that's been unattended to, and now it's major work, versus could we have nipped it in the bud if you went every year and said, hey, Bill, your blood pressure is creeping up a little bit, maybe take off 5 pounds or take, take a blood pressure medication.
You get a
And
little
now,
personal now.
sorry. I don't know your history. Disclosure. I don't know Bill's history here. I'll use me. Okay. And so, you don't want to turn around all of a sudden, pass out, have a major stroke because you weren't, attending to those issues that could have been preventative and either deadly or a major expense. So they encourage and give the annual exam, preventative care wellness, just like your dentist you want to go for your preventative cleanings and stuff, is so you don't have $15,000 of root canal work, at some point, right? So they want you to be proactive. Oh, is that tied to the plan, man? That's one of our favorite words here, is being proactive. So your wellness and the MEC feeds into that. Yeah. And
Absolutely.
so that's what you're going to get with these plans. Now, whether you go or not, horse to water, we can't force you to go see your doctors, but it's there for you and it's minimal financial exposure. As Bill said, a colonoscopy is covered, right? You go in for your however many years it is these days recommended. You're not going to be paying for that. It's provided to you. Now, again, depending on where you are with subsidies and price points, that may have some different implications. So we've covered the MEC and the subsidies. We talked about the copays. Copay, real quick, is if you go see your primary, the primary might have a negotiated rate with the insurance company for $80, and they want Bill to pay a $10 copay. So Bill can go see his primary doctor, non-wellness, annual physical. He's got a chest cold, bronchitis, ear infection, whatever. Every time he goes to the doctor, he's going to pay his $10 copay, and insurance is going to pay the rest. Specialist might have a different level copay for, OBGYN or urologist or dermatologist, whatever. So I go to my dermatologist every year. I get an exam. She picks off a couple of things that look nasty and they want, and I just pay my copay, right? So that's all you're at. So again, as Bill used the term, it's negotiated ahead of time. You know what you're getting into. You're accepting a limited amount of exposure in exchange for the bigger picture. The health insurance is for the big stuff. It's not necessarily for the everyday stuff, depending on your income level. So you're going to pick up certain costs for knee replacements and a broken wrist and other things, because those are the unexpecteds. But if it's major, massive, open heart surgery, God forbid, or cancer, well, you're not going to have $1 million liability. You'll pay your annual max out of pocket, whatever that is, and then the rest is taken care of. And that's why the pool of money and the adverse risk side of this is so critical, because, what are the statistics today? 1 out of 4 people are going to have cancer or have cancer. So, the 3 of us to pay for the one, I can't pay for $1 million of my treatment, and neither can the other 3. So the law of large numbers has to help. And that's, this is the crisis that we're facing, right? The last piece, is we bring it to a close for the first session here, is I want to, again, it's education for people is, well, can I get this today? I don't have anything. Well, we've got some challenges, and that is what's called open enrollment and the limitations of time for people to get onto these programs. And then the second piece is the SEP. So let's talk about open enrollment, and let's tie in for those who have that change of life, what a SEP is.
Okay. So your open enrollment period is every fall. And the reason they have the open enrollment period is because these plans only last a calendar year. Okay. So if you started your plan this month, it will end December the 31st. Okay. No matter when you start your plan during the year, it ends on December 31st, and a new plan has to begin on January 1st. So you have an open enrollment period every fall to where you look at the adjustments of the plans, because the plans change every year. You adjust your income levels or what's changed in your family makeup. You adjust if doctors are in network or not now. You have to look at all those different factors, because the plans change and the situations change every year. And that's why you have the open enrollment period there to sign up for that next year. If you don't meet that time period during open enrollment, you don't sign up for something, the only way that you can get on a plan during the year is to have what Bruce called an SEP, which is special enrollment period. Well, you have to have some kind of event happen in your life in order to have a special enrollment period. Some of those events are a loss of coverage through losing your job. Like Bruce mentioned before, if you move zip codes from one to the next, well, that's a life event there. If your spouse dies, if you get married, if you have a baby, there's several different qualifying life events like that will give you a special enrollment period throughout the year. Right now, there are several people that are moving off of Medicaid. When COVID started, Medicaid was expanded and several people went on it. Well, they're taking away that expansion right now. And so they're losing that Medicaid. That is a qualifying life event, and they will be able to get on during the year here and not during have to wait for an open enrollment period.
There's a finite amount of time. So if when we moved from New Jersey, if I had to change my plan, I can't wait 6 months and suddenly try and get in the plan. There's a limited window to report and apply for the changes in that SEP. I believe it's 63 days. Am I right?
60 days before and 60 days after.
60 days before. Okay. So if I can't tell you how many times people call me like, well, when'd you move here? We're recording in April. So they're like, yeah, I moved here in January. I'm like, well, where you been? Like, your SEP's closed already. Like you missed it. So again, there's things people don't know. We're trying to put that knowledge in your hands, that you don't take things for granted, that you stay proactive. You have a life event. You need to make part of this conversation with your advisors to let them know, hey, we just moved to X. Is that going to change our coverage? And then you check, and then you say, yes, that plan's no longer available in that market. You need to go into this plan, and you could still make that change. I got divorced. I got married. I had a baby, as Bill said. So again, folks, we're just trying to give you incentive to be proactive. We want to give you knowledge and information here. That's the backbone of the plan, man. Bill, anything else for the ACA conversation that we may have left off?
I think the main thing is network. So anywhere you go, anybody you see, you need to make sure that they are in the network plan. So you're seeing your primary doctor. If he refers you to someone else, always ask about network before you go and see anybody. Before you have any kind of procedure done, make sure that they are in your plan network, or else you're going to have out-of-pocket cost over and above what the regular network reduction is.
Sure.
And that's the first thing that you get by having a plan is the negotiated rates because of the network you're part of. And so take full advantage of that.
I'll add the cherry on top in that regard. So we said earlier at the show that Bill and I will go in and plug in the doctors that you have to narrow down their plans and where they participate. The but is that information is only as good as the doctor reporting to the system, because Bill and I have experienced more times than we care to describe how many times somebody said, well, you put me in that plan and my doctor's not in it. Well, we checked it. You heard us check it. We showed you we checked it. That's on your doctor. So that extra layer of protection, you could blame Bill and I as your advisor, but you need, as the consumer, to go back to your doctor and say, look, I'm about to sign up for plan X at carrier Y. Are you still participating in that? Because the system said it did. Now, Robin and I will call in a lot of times with doctors, to make sure with the client that they are participating if we feel we're getting mixed information on it. But again, it's not on me and it's not on Bill and it's not on Robin. Like, you as the consumer have to take some action and responsibility too. It's your doctors. My doctor's in my plan and Bill's doctor's in his plan. You got to make sure your doctor's in the plan. Or you say, look, I'm in Cigna. I need to stay in Cigna. Find me a Cigna plan because that's where I just came out of a group plan, right? And I know all those doctors are in that plan. Let's just double check it. Again, it depends on the circumstance. So,
well, the thing with that is to be careful just saying Cigna, right? Because Cigna has several different types of networks.
That's right.
So you need to make sure it's the correct network within that carrier.
It doesn't convey by name, again, as Bill's forewarning, is the carriers have 7, 10, 20 different channels. And so the plan in a group is going to be a different plan than ACA. That might be a different plan in private. And so the networks are going to vary because the doctors might get squeezed on their margins from one network within the same provider than another because they're just not collecting the same fees, right? The same premium. So, again, any other items here? I think we pretty much hit everything here. So let me obviously thank Bill for being with us. We've been talking about the ACA, the Affordable Care Act, Obamacare, as it's formerly known in a lot of circles. We kind of broke down what's so confusing. We try to give you some forewarnings, and education on deductibles and max out of pockets and co-insurance and co-pays and a big piece of subsidies and qualifying events. I think we've covered a litany of items here. So if you didn't catch it all, go back and re-listen to the episode and take some more notes. Bill, how can people reach you? We're going to put your contact info in the show notes. They can always reach us at the Planman, but why don't you give a quick shout to how people can reach you if they have questions or if they're interested in being part of your team? You are the national marketing director of the company, so people might want to pursue an opportunity career-wise as well and come into the fold with Bill. So how can people get a hold of you in either of those regards?
You can use my phone at 314-282-7013. Email is wpauley, Pauley, at myhst.com. Or look me up. I have a website, thepauleyagency.com.
Okay. Again, thank you. We'll put that in the show notes. So again, thank you, Bill, for joining us today. Folks, make sure you stay tuned for part 2 being released after this episode. We're going to break down a little bit more of the alternatives to the ACA and what else is out there. But Bill, thank you so much. Folks, another episode of Ask the Planman. Again, I'm your host, Bruce Weinstein. Love to hear from you. Give us a call at 1-844-PLANMAN. Look us up on any social media, Ask the Planman, YouTube, planman.tv. Just Planman everywhere you can find us. Please like, share, subscribe. Hit us up again. Tell us what you liked about the episode. We'd love to hear from you. And remember, as always, if you need some advice, always get it right. Come ask the Planman. Until next time, thanks again, Bill, for being with us.